Here are approximately 195 countries on Earth. Every single one is in debt, not some of them, not most of them, every one. The United States carries $38.4 trillion. China owes $18.7 trillion. Japan's debt is so large that it exceeds the country's entire annual economic output, a mathematical impossibility in any normal business. Yet Japan doesn't collapse. None of them do. Why? Because the system was never designed to allow collapse. It was designed to make it irrelevant. The system was designed to control. Right now, global debt stands at approximately $323 trillion. That's the combined obligations of governments, corporations, banks, and households across every nation. To put that in perspective, the total economic output of the entire world is only $140 trillion annually. This means global debt represents 235% of everything humanity produces in a year. We are living in a world where the money owed exceeds the money earned by more than 2 to 1. But here's what makes this possible. The people who owe the money are not the same people who expect to receive it back, and they never were. The architecture of modern debt stretches back to July 1944, to a remote hotel in the mountains of New Hampshire called Bretton Woods. As World War II raged, 730 delegates from 44 nations gathered to design a new financial order for the world after victory. America had already won the economic race. 2/3 of the world's gold reserves were locked in Fort Knox. Europe lay in ruins. The Soviet Union emerged as a military power but an economic ghost, and the United States saw an opportunity. The delegates created the International Monetary Fund and the World Bank, institutions designed to stabilize a war-torn world, but they also designed the dollar as the anchor currency. Every nation's money would be pegged to the dollar. Every dollar would be convertible to gold at exactly $35 per ounce. This meant America controlled the conversion mechanism for all money on Earth. That was the point. For 27 years, this system worked. The dollar became the world's preferred currency. America could run trade deficits, importing more than exporting, because the world needed dollars. America could finance its deficits by printing money, because other nations would accept dollars as valuable. America had constructed an invisible empire built not on military occupation, but on financial architecture. Then came August 15, 1971. President Richard Nixon gathered his economic team at Camp David and made a decision that would reshape global finance forever. The gold window was closing. America could no longer redeem dollars for gold. There was simply too much currency in circulation and nowhere near enough gold to back it. The Bretton Woods system was collapsing. If Nixon had simply ended the gold standard and let the dollar become worthless, the American financial empire would have shattered in weeks. Instead, he made a different choice. He asked, if money isn't backed by gold, what gives it value? The answer was what Secretary of State Henry Kissinger understood perfectly: oil. In 1974, with OPEC holding America hostage through oil embargoes, Nixon negotiated a secret deal with Saudi Arabia. The Saudis would price all their oil exclusively in dollars. In exchange, America would provide military protection, aircraft, training, weapons, soldiers. By 1975, all OPEC nations had agreed to the arrangement. Oil was now priced in dollars. The entire world needed dollars to buy energy. The dollar had found a new anchor. This petrodollar system remains in place today. 58% of all global currency reserves are held in dollars. 90% of all foreign exchange transactions use dollars. 96% of trade conducted by the Americas uses dollars. When you pump gasoline in Tokyo or Dubai or Sao Paulo, you're conducting a transaction that fundamentally depends on American financial architecture. But here's the crucial insight. A nation that controls the currency that others must use has an extraordinary power. It can run deficits that would bankrupt normal nations. It can print money to pay its debts. It can use financial sanctions to punish adversaries. It can wage wars financed by other countries' savings. And it has. The machinery that makes this possible is distributed across multiple institutions, each with different roles, yet all serving the same ultimate function: keeping debtor nations compliant with the system that profits creditors. The International Monetary Fund sits at the top of this structure. Today, the IMF has $162 billion in outstanding loans to 86 countries. Argentina alone owes $57 billion, making it the most bailout-dependent nation in modern history, with 23 separate IMF programs since 1956. But money isn't what the IMF really sells. It sells hope, and it sells conditions. When a country faces a financial crisis, it doesn't simply borrow from the IMF and leave. The borrowing country must agree to what are called structural adjustment programs. These are detailed policy mandates that shape what governments can do: reduce government spending, austerity, privatize state enterprises, liberalize trade, devalue currencies, cut subsidies on food and fuel, eliminate price controls. These conditions are not suggestions. They are prerequisites for receiving the next tranche of funds. What's remarkable is that these programs, after decades of implementation, have been studied extensively by economists, and the research is conclusive: they don't work. A comprehensive analysis of 175 countries over 34 years found that IMF structural adjustment programs have no robust significant effect on export growth, economic complexity, or development. Yet they persist. They persist because they were never designed to develop economies. They were designed to ensure debt repayment. When a country implements austerity, cutting government spending, firing public workers, reducing services, government revenue increases because workers are paying less income tax and the economy contracts. But debt payments remain fixed. This is the machinery at work: transfer wealth from citizens to creditors. Consider Greece. In 2010, Greece faced a debt crisis. The IMF, European Central Bank, and European Commission, the Troika, offered rescue packages totaling €320 billion. In exchange, Greece accepted 12 rounds of austerity measures. Corporate taxes increased. Personal income taxes increased. The VAT jumped to 24%. Pension payments were slashed by 30%. Public sector workers were fired. Healthcare and education budgets contracted. The Greek economy collapsed. The country contracted 25% in total output, the longest recession experienced by any advanced economy on record. Unemployment reached 28%. Youth unemployment exceeded 60%. Homelessness, suicide, and drug addiction surged. Infant mortality increased for the first time in decades. Yet the debt didn't disappear. It grew. As the economy shrank and tax revenues fell, debt-to-GDP ratios actually increased from 130% to 180%. The austerity designed to restore solvency made solvency mathematically impossible. IMF economists Blanchard and Lee later conducted a mea culpa analysis, acknowledging they had massively underestimated fiscal multipliers, the way that austerity deepens recessions. The Peterson Institute concluded that Greece's rescue was designed primarily to protect creditors. Forced austerity aimed at enabling the Greek government to pay its debts made it harder to meet that goal. This is not exceptional. This is the system operating as designed. Alongside the IMF operates the World Bank, technically a development institution, which provides longer-term lending for infrastructure projects. In practice, World Bank loans often come with similar conditionality, and much of the infrastructure financed serves to extract resources from debtor nations to pay creditors. Roads built to export minerals, dams built to power mining operations, ports expanded to handle agricultural exports. Development is defined as the ability to service debt. Then there are the credit rating agencies: Standard & Poor's, Moody's, and Fitch. These three firms control 95% to 96% of the global credit rating market. They rate the creditworthiness of governments and corporations. This rating directly determines how much those entities must pay to borrow. A single downgrade can add hundreds of basis points to interest rates, potentially triggering debt spirals. Consider what happened when the Federal Reserve began raising interest rates starting in March 2022. Each rate hike rippled through the global system. Developing nations that had borrowed in dollars now faced interest payments that doubled, then tripled. Argentina's borrowing costs exceeded 30%. Pakistan struggled to refinance its debt. Zambia, Ghana, Sri Lanka all defaulted. Turkey's currency collapsed. The rating agencies mostly watched passively until they suddenly downgraded nations facing crises caused partly by their own previous ratings being too lenient. Remarkably, these same agencies gave AAA ratings to complex mortgage-backed securities before 2008, products so toxic that their failure helped trigger the global financial crisis. The Financial Crisis Inquiry Commission concluded these rating agencies were essential cogs in the wheel of financial destruction, yet they were never held accountable. They continued operating with the same flawed models, the same conflicts of interest, the same outsized power over nations. Central banks form another layer of this architecture. When the Federal Reserve raises rates, it shifts the burden of American inflation onto borrowers worldwide. When the Bank of Japan maintains near-zero rates while other central banks raise them, it creates carry trades that destabilize emerging markets. Central banks claim independence from governments, yet they have become the primary monetizers of government debt. The Federal Reserve's balance sheet expanded from $900 billion before 2008 to a peak of $9 trillion in 2022, nearly all acquired by purchasing government securities and mortgage-backed assets. The Bank of Japan now owns 46% of all Japanese government bonds. The ECB owns massive quantities of European sovereign debt. This creates a peculiar situation. Governments issue bonds, commercial banks temporarily purchase them, then those banks sell them to central banks at a slight profit. The government debt is ultimately held by the central bank, which is technically independent but really just another arm of government. The debt remains on the books, the interest must still be paid, but the debt holders are satisfied because they've sold their holdings and taken a profit. It's a shell game that allows governments to pretend they're not directly monetizing their debt while doing exactly that. Then, beginning in 2000, a new creditor emerged. China, having joined the World Trade Organization, began accumulating massive trade surpluses. Rather than allowing this surplus to simply accumulate as domestic inflation, the Chinese government redirected it into overseas lending. Since 2000, China has lent approximately $1.1 trillion to other nations. This is more than the IMF, the World Bank, and all Paris Club countries, the traditional Western creditors, have lent combined. Now here's where the narrative becomes interesting. Western media has constructed a story about debt trap diplomacy, the idea that China deliberately lends money at unsustainable rates to countries it knows will default, so that it can seize strategic assets like ports and infrastructure. The story is compelling. It fits with Cold War narratives, and it's almost entirely wrong. The reality is more subtle, and in some ways, more revealing about how the entire system works. Consider Sri Lanka's Hambantota port, the poster child for debt trap stories. China Exim Bank provided $1.26 billion at 6.3% interest to construct the port. When Sri Lanka faced a broader debt crisis, caused by loans to Western creditors, not just China, it leased 70% of the port to a Chinese company for 99 years in exchange for $1.12 billion. This sounds like debt trap seizure, but here's the critical detail. Sri Lanka still owed the original construction loans. The lease proceeds went to pay back creditors other than China. Similarly, when Kenya borrowed $5 billion from China for a standard gauge railway at 2% interest over 20 years, this was actually better terms than it could have obtained from commercial sources. Yet the narrative became that Kenya had been trapped into unsustainable debt. The reality is that Kenya faced debt distress from all creditors combined. 60% of tax revenue now goes to debt servicing, but China's specific lending terms weren't the primary problem. Academic research from institutions like Chatham House, Johns Hopkins, and Georgetown has systematically debunked the deliberate debt trap narrative. China has never actually seized a major asset from a defaulting country. Its typical response to default has been debt rescheduling or partial cancellation. The most fragmented creditor landscape, 18 different Chinese lenders, belongs to Zambia, which suggests Chinese lending isn't even coordinated, let alone strategically designed. But this doesn't mean Chinese lending is benign. Chinese loans typically carry higher interest rates than concessional multilateral financing. Terms are less transparent. Collateral arrangements sometimes include unusual cross-default provisions that give creditors leverage over broader policy. And critically, China's emergence as a major creditor has fragmented the creditor landscape. Whereas previous debt crises involved coordinated creditor negotiations, a Paris Club of government creditors, a consortium of commercial banks, Chinese lending has made restructuring more complicated. There's no single negotiating partner. What's become clear is that the global debt system has adapted. The petrodollar system that emerged in 1974 is not being replaced by an alternative, but rather supplemented. China lends alongside, not instead of the IMF, World Bank, and Western banks. But China's terms, while sometimes better on paper, serve the same function, keeping debtor nations dependent on future lending, unable to invest in their own development without external approval. This becomes clear when looking at what happens when countries try to break the cycle. In 2019, developing nations paid $921 billion in net interest payments. That's interest payments minus interest received. This was a 10% increase from the previous year. This number accelerates every year as debt stocks accumulate and interest rates rise. For context, 3.4 billion people now live in countries where interest payments exceed government spending on health or education. That's nearly half the world's population. In Africa, 25 countries spend more on debt interest than on healthcare. In Asia and the Pacific, 2.1 billion people live in nations choosing debt payments over essential services. How did we arrive at this point? By a deliberate series of decisions, each one designed to entrench creditor power. The first came after World War II with Bretton Woods. The second came when gold-backed currency was abandoned for petrodollars. The third came when interest rates spiked in the 1980s, forcing Latin America into default and establishing the pattern. When countries can't pay, they accept IMF conditionality rather than negotiate collective debt reduction. That pattern was reinforced in 2008, when American banks made catastrophic bets on mortgage-backed securities and the system nearly collapsed. The response was clear. Governments would absorb the losses and maintain creditor power. The Federal Reserve purchased trillions in assets. Governments transferred hundreds of billions to banks. The losses were socialized, the profits privatized. Then in 2020, COVID-19 forced the single largest debt increase ever recorded. In 2020 alone, global debt rose $24 to $32 trillion. Governments needed to borrow to pay workers who couldn't work. Then, as economies reopened, inflation spiked. Central banks responded by raising interest rates aggressively. They did this despite knowing it would harm developing nations reliant on dollar borrowing. The Federal Reserve chairman was explicit. The Fed's mandate is domestic, not global. If Americans face inflation, rates rise, regardless of the impact on debtors elsewhere. This is where we stand now. Rising interest rates have meant that developing nations borrowing in dollars face doubled or tripled interest payments. When you double interest payments, you have the room for development spending. $4.5 trillion in emerging market debt matures between 2024 and 2026. For low-income countries, approximately 20% of total debt matures each year, forcing them to refinance at much higher rates. The IMF now classifies 55 countries, 55% of least developed and low-income nations, as being at high risk of debt distress or already in distress. This is the most countries in debt distress since the IMF began tracking the statistic. Zambia became the first African nation to default during COVID. Ghana nearly defaulted. Kenya is on the brink. Argentina has defaulted 9 times in its history and faces another default. And emerging from this systemic stress is a question that policymakers are beginning to ask quietly. If 55 countries are in unsustainable debt, if they cannot possibly repay without condemning generations to poverty, what happens when they're forced to choose between creditors and citizens? The precedent exists. After World War II, Germany owed $370 billion in reparations, an amount that would require thousands of years to repay. In 1953, at the London Debt Conference, 80% of German debt was forgiven. Repayment was limited to 5% of German export revenues. This relief created fiscal space for investment, education, and infrastructure. West Germany experienced its economic miracle, sustained 8% growth, rising living standards, rapid reconstruction. Yet when developing nations today request equivalent treatment, debt forgiveness based on their limited fiscal capacity, they are told it's not feasible. The system has no mechanism for orderly debt reduction. Countries either accept austerity that destroys their economies or default chaotically that destroys investor confidence. This brings us to the fundamental truth that the system is designed to obscure. Debts that cannot be paid will not be paid. It's not a question of whether, it's a question of when and how. If debts are paid through default, creditors lose. If they're paid through austerity, citizens lose. If they're paid through inflation, savers lose. If they're paid through currency devaluation, poor nations lose. The only scenario where debts are paid without obvious losses is if growth is sufficient to expand economic capacity faster than debt accumulates, but growth is slowing. Demographic trends are negative in developed nations. Climate adaptation will require unprecedented spending that reduces growth rates. The math is becoming harder. So the system persists by accepting the impossible. Countries remain perpetually indebted, perpetually dependent on future lending, perpetually unable to invest in their own futures. It's a system that works perfectly for creditors and ensures poverty for debtors, and it was designed that way. The irony is that this system was built by nations that understood debt intimately. The United States itself defaulted on its debt in the Reconstruction Finance Corporation scandal and through the Great Depression. Britain restructured its debts multiple times. France defaulted repeatedly. Yet once these nations achieved creditor status, they enshrined their power through institutions designed to ensure no future competitors could ever escape. Now those institutions face their own crisis of legitimacy. Zambia's restructuring took 4 years and still didn't resolve the dispute between Paris Club creditors, Chinese creditors, and private bondholders. There's no agreed mechanism for ensuring all creditors participate in burden sharing. Private bondholders, hedge funds that purchase debt at discount, have enormous incentive to refuse concessions and force holdout positions, knowing that debtor nations will pay to avoid complete default because the alternative means losing access to all future credit. And deeper than these institutional failures lies a question of basic sustainability. If 3.4 billion people live in nations choosing debt payments over healthcare, education, and climate adaptation, can the system truly sustain legitimacy? At what point does austerity become so severe that political systems rupture? We're beginning to find out. Brazil has proposed a global wealth tax. The African Union has demanded debt cancellation. The BRICS nations are discussing alternative settlement currencies to reduce dollar dependence. These are not marginal movements. They represent the world's majority population beginning to question whether a system designed 80 years ago in New Hampshire should remain binding today. Architecture of global debt remains, for now, intact. Central banks still monetize government obligations. Creditor nations still maintain voting power in the IMF and World Bank. Rating agencies still shape borrowing costs. China has joined the system as a creditor rather than fundamentally altering it, but the cracks are widening. Interest rates are rising. The mathematics are becoming impossible. Debts that were sustainable at 2% rates become unsustainable at 6% rates. The system's greatest strength has always been its invisibility. Most people don't understand how it works. They see interest rates as natural phenomena, like weather. They see government budgets as constrained by fiscal responsibility rather than by the terms creditors impose. They see their own poverty as reflecting personal failure rather than systemic design. But understanding the system is the first step toward questioning it. And once people understand that their governments spend more on debt payments than on schools because they made different choices in 1944, in 1971, in 1980, in 2008, once they understand that alternatives existed, the legitimacy of those choices becomes fragile. The question that will define the next decade is whether the system reforms through ordered debt reduction, genuine development rather than debt servicing, restructured institutions with broader representation, or whether it ruptures through cascading defaults and currency crises that remake the global order in ways we can't predict. Until then, the system persists. Every country on Earth remains in debt. Every country remains dependent on future lending. And the architecture that made this possible, the petrodollar system, the IMF, the World Bank, the rating agencies, continues to shape the possibilities available to humanity. Understanding this architecture is not academic. It determines whether billions of people have access to healthcare and education. It determines whether nations can respond to climate change or remain locked in serving creditors. It determines the trajectory of human development for the remainder of this century. And it all flows from one simple decision made in New Hampshire in 1944, that the world's debt would serve the world's creditors.